Welcome. I'm Catherine Magana here with Greg Carroll, JR Phillips, a special guest, and Rachel Ivanovich, where we're here to provide insights about the markets, tax planning, and today we're going to have a special discussion on the real estate market. So we do want to welcome JR Phillips here with us from Phillips & Company. He brings a wide depth of information about real estate, so we're really excited to have you join us here today. But before we dive into that, I just want to give you an update of where we're at with the markets. So today is March 20th, and over the last week, we've actually seen the markets go up a little bit, which is nice. A little breathing room here.
Been a little choppy.
I know. So now the Dow Jones is still down for the year, but it's up over 1% from last week. The NASDAQ, which is more of the tech stocks, that's up a little bit, about 0.5% from last week, but it's still down the most, about 8% this year. The S&P 500 is up from last week a little over 1%. Year to date, it's down about 3.5%. And the biggest movement we've seen is in the Russell 2000, which is more of the small cap stocks. That's actually up about 2.5% from last week, but is still down year to date a little over 6.5%. So we're still seeing a little bit of market movement. Obviously we went into some correction areas, still not a bear market. We've definitely been having a lot of conversations about the markets and tariffs and taxes, and there's a lot of moving parts here. But at the end of the day, we still believe in having a diversified portfolio of investments, and we're here to talk about your specific situation as needed.
Yeah, I think part of the volatility in the stock market recently has been obviously the tariffs that everybody's talking about. Mm-hmm. It is a tax. It is going to increase some prices. But I think what people also need to realize is that the stock market is fairly overvalued at this point. We came into this year, last 2 years up 25%-ish, the last 2 years. We've come a long ways. No matter how you value the market, it's pretty high. Whether you look at the Buffett indicator, the Fed model, the Shiller P ratio, things are expensive. So when you get some of the uncertainty with these tariffs, and the tariffs are on again, off again, this country's in, that one's out, phone calls change things. Some of the froth is coming out of the market, and especially when you've got a narrow market where 10 stocks are a third of the overall capitalization, which we've talked about many times. There's 490 stocks that haven't participated that may not be overvalued. So, the old saying is it's a market of stocks, not the stock market, that you really want to be looking at. So I think, as long as you've got a good long-term plan, you've got a good diversified portfolio, there's still a lot of opportunity out there. And as long as you're not as concentrated in those Mag 7 stocks or the top 10 stocks, you're probably doing much better than what the indexes are.
Yeah, and it's interesting. We've seen as some clients that had cash on the sidelines, so maybe some CDs came due, or they have some new money that's coming in from a sale of a house or inheritances. And interest rates on the short term aren't as attractive as they were a year ago, but they're still decent. Right now, our 6-month CD rates are about 4.29, and 1 year are about 4.1, and treasuries are pretty comparable. But what we are finding is some clients are putting money kind of slowly into the market and buying into these dips. So there is some opportunity if you have some cash or to buy in. I mean, we do have a long-term perspective, but there's definitely some opportunities to buy into this market. So let's dive in about real estate. So JR Phillips, maybe tell us a little bit about your background, and then you can dive into the real estate market.
Sure. So my name is JR Phillips. I'm the owner, founder, lead broker at Phillips & Company Real Estate here in North County, San Diego. I've been doing this almost 25 years. I've been in the residential real estate market. So I think I've seen about every type of market that you can imagine. I've dealt with rates going up, rates going down, market collapses, which
2008 was rough.
Yeah, 2008, complete market collapse. Yep. Coming out of that with short sales and the opportunities. What you learn in all these different types of markets is whether it's going up or down, there's opportunity. And if you stick to a strategy, which is what you guys do for a living, is if you stay true to what you really want to do, you're going to come out okay. And I say that in that if we don't look at the house as a way to, a home has always been a shelter. It's always been a place for us to raise our families or live our lives. We've had a really good run in residential real estate the last 20 to 25 years, where in many places in the United States, many metro areas, California, New York, Florida, certain areas, Chicago, metropolitan areas, the house has become a life-changing investment where it can literally change the trajectory of someone's life financially. And overall in the country, people have begun to look at their home as something that they expect to perform in a certain way for them. And what we're finding right now is that the market is heading back more towards a traditional, steady market. We're not going to see the 10 to 15% growth that we've seen in our residential homes, which is unsustainable anyway. It's great that we had it, but we need to understand that there are many variables that play on the values of residential real estate. But a steady 3 to 4% growth, which is where we're seeing the national forecast right now, is at 3 to 4%.
But everybody wants those 15, 20% growth.
Yeah,
it's like, wait a minute.
That's what they want, but it's not sustainable.
Yeah. Not the norm.
And then we have to get into a whole nother conversation, which, by the way, we could probably do 5 podcast episodes on this subject. But you have to get into affordability, and at the end of the day, homes have to be affordable in order to have a sustainable market. And that leads us into all the other different dynamics that we're seeing in the financing of residential real estate across the country, which you guys are experts on, this giant baby boomer transition of wealth that's taking place, that started a few years ago and is taking place over the next 15 years. A lot of people would say, why are you talking about the transition of the baby boomer wealth? Well, in our day-to-day transactions, I maybe saw 1 or 2 gifts of money from parents 5-6 years ago. Over half of the transactions we deal with now usually incorporate a gift from parents or grandparents.
Absolutely.
And it's moving in the direction where you would say, I don't think it's crazy to forecast that in 5 years, 70% of our transactions have a gift. And the gifts are growing in size. They used to be $100,000, then $250,000. We've seen $800,000 to $1 million gifts.
Wow.
And that's absolutely true. I've seen that so much. So I've been doing taxes for 25 years, and the last 2 years of the first years, I've been doing gift tax returns for clients where the parents or grandparents are gifting the down payment to their grandchildren or their children.
And that leads us into a lot of other conversations that we probably won't have today, but the haves and the have-nots. As a region in California or other metro areas where it's expensive, if you want to keep your family together, if you want to be close to your family, how practical is it that your kids and grandkids can stay by you? And it becomes very difficult. And those are conversations that we have with our clients that we didn't used to have years ago. So the dynamic of our conversations have changed along those lines.
So are you seeing, I've been having conversations about clients that either want to sell their home and move out of state or maybe sell their home here and buy something completely outright somewhere else. It seems that's been on a lot of conversations around that. And then also there are people that move to the area as well.
Yes.
But then also there's, like you talked about inheritances. We're seeing some spouses, get the property and sell it and buy something else potentially, and there's some tax.
We've seen every aspect of that. We generally see the influx coming from Northern California, the Bay Area. And believe it or not, in the San Diego region, for the rest of the country, they would view our property prices as extremely high and unaffordable. When you come from the Bay Area,
We're cheap.
They're like, we're reasonable.
We're very reasonable.
Yes.
But we're desirable.
Yeah.
So we're desirable because we afford them a little bit more of an outdoor lifestyle if that's what they want. We afford a little more pleasant climate. And it's just, I think, a little bit more of an enjoyable lifestyle. So we are seeing them as the shackles of the offices were taken off of everybody in COVID. We saw a lot of people move down. We do. I have 10 agents. To give you a little more background, we have 10 agents that work within our organization. We see a handful of clients still leaving the state. Usually comes down to affordability as they approach retirement. They're working with you guys, and they're trying to decide if the X that they have in the bank is enough to have the lifestyle. We don't see as many people leaving in knee-jerk reactions.
No.
anymore, and to some political views or things like that. It really does come down to affordability, and I go back to that word. It's the third time it's come up. And when you're in different phases of your life, if you're not getting gift money, can you raise your kids here? If you're not making enough money professionally, can you afford to live here? And then when you go to retire, can you live here? And we have a handful of clients every year that decide that they're going to be able to enjoy their retirement a little bit better in Tennessee or Texas or Montana or somewhere else.
I honestly have seen that so much in the last 2 years, and everything that you're touching on is what I'm seeing with my clients as well, that they're either helping children and grandchildren buy homes here, or B, they're moving out of state and then they're buying land and building, and because let's just say you sell here and you've had that massive appreciation in the homes here, and then all of a sudden, this is the first time I've seen in 25 years where people are paying income taxes on the sale of their primary residence because the $250,000 exclusion that each individual gets is not enough. And so I've got spouses who are saying, well, what do I do? I've got, their home is worth $2 million. They bought it for $200,000. They put in, $200,000 of improvements, and they have the $500,000 exclusion, but there's really not enough. And so it's, what can we do? But I think it's really interesting that you touch on that, because it's absolutely
and again, true. We touched upon it earlier. There's multiple facets to this conversation. And the other facet that I think is important for us to talk about today is a few years ago, interest rates got to astronomically low levels, something that we never imagined could happen, and I don't think we'll ever see in our lifetimes again. And we have this enormous group of people across the country that are tied to 2.5% to 3% mortgages, and they're not making life choices and not moving forward in their lives relative to their houses because of these interest rates.
They love the rate, not the house.
They really love the rate.
I love it too.
and I did a lot of interviews similar to this in the late teens and 2020 when the rates were down, and I forecasted this, and I was some people in the finance industry, and they told me, no, I don't think, Jared, I don't think you're on there. And I'm like, I'm pretty sure I value my mortgage rate, and I'm pretty sure I like to have a really low, sustainable mortgage payment. I'm just one person, but I think that's a human thing, and here we are. And that is a big part of what's going on in the market. It's one of the many variables that are
So do you think with interest rates, they've been between 6 and 7%, bouncing around a little bit. We're used to those low rates. They've been up to 8% almost, and it's now the 6-7%. Are you sensing that people are starting to say, okay, this is where we're going to be for a while, and let's just adjust to that? Because I know when I bought real estate, many years ago, it was like 10 or 11%, and so now, we all expect those 3%. But
yes, so definitely we're starting to see, like the chief economist at NAR is pointing out that rates have dropped consecutively for 6 weeks. They're getting back to a more level. There's something that we talk about with our mentors or the older generation in real estate. And it's if you had a 7% mortgage, which for the sake of this conversation, if you had a 7% mortgage in 1973, you were able to get that. And if you waited for that rate to go down, you were able to buy a home in 1993.
Wow, yeah.
So we have to really,
waiting for a while.
as advisors, whether we're helping them plan for retirements or their financial future, or we're helping them to make sound decisions about their home, we have to advise from that perspective. We have to help them to understand that the rate is just one component of what is going on here. And it's not what's on social media. It's not what's on the news every night. It's not as flashy to have these conversations. But we have to understand that the rates are probably going to settle somewhere here around 5.5 to 6 over the next couple of years. And they're probably going to stay here for quite a while because there's a lot of smart people that analyze this stuff like yourselves that says this is where we need to be for the next 5 or 10 years. So getting used to having a 6% mortgage, I would advise my clients they should adapt to that and not look for those huge dips, because I don't think they're coming.
Well, 25, 30 years ago, that was the rates, right? In the 90s and early 2000s, you're going to pay 5-6%, and that was a
6%
really
was a good rate.
That was a really good rate.
I remember personally when I bought my first home in the 90s, I had like a 12.5% mortgage, and over the 4.5 years the first 4.5 years, rates began to really drop. Right. And every year my mortgage vendor would call me, my mortgage officer, and say, hey, we can do a no-cost refi and take you down to 10. Okay. We can do a no-cost refi, take you down to 9. I got down to 6.25, and I remember walking around, I felt like I had scored. So right where we're at, we're just a little bit higher than that right now.
Right.
And 25, 27, 28 years ago, I felt like I had
won the lottery.
I won the lottery. I had conquered everything. So
it is funny how you talked about the affordability, and the interest rate plays into that. And if you can afford it, you need that house. You want to be in that environment wherever that is. The interest rate, I think people do look at that, and it is a roadblock for a lot of people when it's not. It's just a piece of the puzzle.
Yeah, and it is nationally. When we're looking nationally, if we're in non-metro markets, those interest rates can play a massive role, because you're talking about a completely different animal when you're purchasing homes in areas that are not metro-based, not coastal-based. It's all relative to where you're at. But I try to help the clients see that if you look at, we've had several clients over the last 10 years who have tried to time the market. If I were able to set each one of them down here for this episode right now, they would all say, we regret trying to time the market, because they usually end up buying a similar home that they wanted for more money. And if your prices come down but your rates go up, or your rates come down and your prices go up, so it's really important that you work with advisors that can help you kind of see those realities and navigate through that. Because if you get too hung up on being the guy at the barbecue or in the pub that can say, I have a 2.9% interest rate just so you can win in the conversation, you're going to lose. I mean, you have to buy a home from a place of strategy, and ultimately a home is a home. Yeah. So hopefully we're not just looking at numbers that are going to help you be the popular guy at the party.
Yeah, buying and selling real estate, it's not like buying and selling AT&T stock. It's not a trade. It's something long term. And I remember
we don't recommend that.
We
stock.
don't recommend.
We don't
recommend that stock.
Any stock. It doesn't matter what. Yeah, sorry about that.
Yeah. We're just referencing that.
But I remember a financial advisor back in the late 90s sold his house. He probably had it, since the early 90s, so it was less than 10 years. Made a good profit on it, but he sold it. He thought real estate was high.
Yeah.
He did not buy in. I'm not sure of the numbers, but probably another 10 years. He's like, I got to get back in.
Yeah.
And think about what he missed out on, right?
And that's, we call it the real estate train. Here in California is a little different. Like I've tried to be really clear today, it's different here than it is in other places in the country. But in most metropolitan areas or coastal areas, get on the train. Mm-hmm. We try to tell our younger clients, quit trying to time it perfectly.
Right.
Get into the market. It is going to reward you. Ultimately, there will come a time when prices will ultimately plateau. And I think the conversations 10 to 15 years from now will be totally different. I don't think homes will continue to go up in value forever and ever and ever, because there are affordability variables. And I think people in your industry or my industry will be having completely different conversations in 10 to 15 years. But that being said, trying to time the market, I haven't seen many people do it well. And I think from your side of the table, and
we feel the same way. It just
doesn't work.
It's like you may have time it on the way out, but when do you get back in? And the markets move very quickly, at least with our industry. But so, can you share a little bit? Last year, there was a lot of headlines and talk about the real estate industry and commissions and how agents are getting paid with buyers,
especially buyers, yes.
Buyers and closing costs and all that. Can you just kind of give us a little context about that? Because I know there was a lot of headlines, and then now that we're in it, how is it going?
A lot of headlines. Yeah. So a lot of people weren't aware that a major lawsuit was filed in 2019, and it had been going on for 5 years. Our industry and our leadership was probably asleep at the wheel a little bit. They couldn't imagine that this case was going to be granted class action status. And it was about halfway through that period. And they couldn't have imagined that a system that had evolved over the last 40 or 50 years to really serve buyers and sellers really well was deemed as not serving buyers and sellers really well, and that it was going to be changed dramatically. So the end result ended in that we no longer can have a seller predetermining what is going to be paid to a buyer's agent. So the way that they were rules and court orders that came out, and by the way, I would say in California it was adopted January 1st. These are now the law.
Okay.
In January 1st, this became the law. If you cannot have a proposed commission in the MLS for a buyer. That is no longer allowed. They viewed the MLS as a fixed situation where it created antitrust, where buyers and sellers weren't allowed to act freely and make decisions on their own. So you can't have commissions in the MLS anymore for a buyer's agent. If you're going to represent a buyer, this is the big change that everybody's talking about. When we're representing buyers, before we can show you a property and go to work for you, you now have to sign an agreement saying that we represent you. Okay. Now that agreement can be exclusive or non-exclusive. It can be for one property or it can be all-inclusive for all properties. So it's really comes down to what type of a relationship do you have with that client. What are they looking to do? If you have a long-term relationship with them, they're probably not going to hesitate to sign an exclusive agreement. But when you have people moving into the city and they don't know you as well, you're going to have to adapt your approach with them. The hang-up comes in that for the first time, buyers are signing an agreement that does state if they buy a home, they owe you the commission. The buyer owes the commission. What they're needing to understand is how this has played out over the first 6-7 months, is that still almost 90%, about 88%, and I'm speaking for Southern California, about 88% of the transactions that are closing, the seller is paying all or at least some of the buyer's commission.
Well, and do you think it's because that's the expectation that we're used to that, and maybe that's kind of going in, you think?
I think there is some of that there's some legacy tradition to it, but I also think that it comes down to applying just a human nature and common sense. If you're not offering something that's as good as what the other home is offering, your home is probably not going to get shown as often, and you're probably not going to sell it for as much. There are cases where a seller can sell the home on their own and they can have a good result. Rarely does that happen. Real estate transactions have grown to be incredibly intricate and difficult. The legalities involved, the contracts, and for example, when I started in this business almost 25 years ago, a real estate transaction file was about a half an inch thick.
Now you're signing your life away.
From a paper perspective. Now, we no longer have paper files, but if we did, they would be about 2.5 inches thick. Yeah. The amount of forms and legal documents that are signed are incredibly intricate, and having a professional that can navigate that for you is really important. But the real change is, if you're a buyer, you're going to have to sign an agreement with an agent to represent you. If you're a seller, you're not going to be able to advertise in the MLS. You can advertise everywhere else, but not in the MLS, that you're going to afford a buyer's agent a commission.
But it kind of sounds, since you're signing an agreement, you're basically, instead of having a buyer deal with 10 different agents, now they're saying, I'm going to work with you. So in actuality, it is, I think there's some benefits to it.
There are some benefits to it. And like I've been doing this for so long, I'm so used to having my cheese moved in this industry. We've had changes from the lending side, changes from the contract side. We get contract updates every December and every June in California.
Sounds like taxes.
So we have to sit down twice a year with our team and go over the changes that have taken place. So it's nothing really new. And there were a lot of forecasts and a lot of drama in the media that this was going to dramatically change things. Again, I forecasted last year, let's see what 90 to 120 days brings. And I have a feeling that things will probably morph into not being that big of a deal. And I was right. The two of the main forms that we had to have signed 6 months ago, one no longer exists at all. It only lasted about 5 months and it was retired. And the other one has been morphed and blended into the contract, and it's been changed. So I think you adapt. And then it's on us as advisors to help buyers to understand how this is benefiting them. But again, human nature is, many sellers initially are like, great, I don't have to pay
Yeah.
commission anymore. And buyers are like, oh
I'm not
boy.
paying- well, they didn't probably save for that down payment.
Where do I come up with that extra money?
Yeah.
So from our perspective as advisors, we've had to navigate some pretty choppy waters, and it's misinformation is everywhere. So we have to work through those things. But I think overall, like you said, I think it's a good thing. And at the end of the day, it's the law. Mm-hmm. So you need to get on board and adapt and help your clients to be successful.
So I heard you say there are two types of buyers in a conversation that you're having. So tell us a little bit about that.
We've always heard the traditional description of the market is it a buyer's market or is it a seller's market? And I adhered to that thinking for the first maybe 15 years of my career. Mm-hmm. And then as I saw things change with rates and I saw things change with the transition of the baby boomer wealth, and I saw all the different variables that were playing on the real estate market, I started to pay a little bit more attention to the buyer. And what were my interactions with our buying clients like? And I came up with, I believe that there's two types of markets. The buyer's either talking themselves into buying a house or they're talking themselves out of buying a house. Now, that can be a buyer or seller's market, but really what it comes down to is when you're interacting with that buyer, if it's a talk yourself out of buying the house, it's probably things are probably gravitating more towards the buyer. The seller's going to have to negotiate more. And it's really important that as agents, we go back to our sellers and say, hey, the buyer is seeing this, this, and this with your home. And they're like, wow, buyers never looked at that before. It's because they're doing everything they can to tell themselves they shouldn't buy this house. And like 18 to 20 months ago, we were in the talk yourself into it. Mm-hmm. You didn't even have to paint a rusted screen door. If you had torn screens on your house, it didn't matter. They were just seeing right past everything.
I want that house.
I want that house.
I want
They're
it
talking
now.
There's only one house left in all of Southern California. I'm getting it.
We need 4 bedrooms. This only has 2. We're good. And then as an agent, as a buyer's agent, you have to be very mindful to make sure that you bring them back. So when we represent a buyer, the first thing that you have to do with us is you have to write down the list of 10 things that you want in a home, and you have to put them in the list of importance from 1 to 10, 10 being the least important. And we tell our clients, if you start to check 5 of those boxes, you're probably in a home that you should start to look at as a potential home. If you check 7 of those boxes, and they're most of your top boxes, you should probably buy that home. And it helps us to eliminate a lot of the emotion that goes. If you come back to a logical list and thought process, you can buy the home. There's no way to get all the emotion out of spending a lot of money and buying a home. It's an emotional occurrence. But we try to use that tool to help us stay in a more grounded, logical approach to buying the house. And I'll tell you, we have a lot of success with it.
So what's a good way for our listeners to contact you if you have an email or phone number or a way they can reach you?
Yeah, they can reach me at jr@phillipsandco-re.com. That is also our website, Phillips & Co.
It's Phillips with 2 L's.
Yeah, Phillips with 2 L's, phillipsandco-re.com. And the phone number is 760-402-5321, and that's my direct line, and you'll find out that I do pick up the phone. I am a working broker, and I'm very active.
Nice. And we also have had clients reach out to us. If you need to get that contact information, we're happy to share that. But it's been very insightful. Thank you for going in depth on the real estate market and some trends and interest rates, and we're really appreciative having you here. Rachel and I have known JR for over 10 years here in the community. He's a community leader, business advocate, and business owner, so we really value your time and relationship. So thank you for joining us. And I think that concludes today's podcast, and thanks for listening, and until next time.
Bye.
Great.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.